Welcome to Fundraising Course for Startups. In this course, we'll unlock the secrets to securing the funding your startup needs to thrive. From mastering the fundraising mindset to crafting compelling pitches, you'll learn strategies to navigate rejection, tell your story, and negotiate like a pro. Discover the funding landscape, whether it's seed funding, venture capital, or crowdfunding, and build the perfect pitch deck that resonates with investors. With practical tools, real-world insights, and actionable advice, you'll leave equipped to attract the right investors and grow your business with confidence. Let's get started on your journey to funding success. Effective fundraising methods for startups. Securing funding is crucial for startups to thrive. This course shall equip you with essential fundraising knowledge and strategies to propel your startup towards business success. Let's look at how-to components of developing the fundraising mindset. Passion and belief, resilience and perseverance. This involves navigating rejection, adapting to feedback, and continuing to pursue your vision. Communication and storytelling, effectively conveying your vision, passion, and potential to investors. Negotiation and deal-making, understanding terms, managing expectations, and securing favorable agreements. Startups have several alternatives for raising funds. One may opt to equity-based financing that will cover venture capital, angel investment, accelerators, crowdfunding, and stock market IPO. We also have debt financing that encompasses SMEs loans, inventory financing, overdraft financing, and invoice financing. Then we come to revenue-based financing, including VCs, banks, e-commerce platform, and SaaS/recurring revenue platform. There is also equity-free financing that comes from competition, grants, and incubators. Finally, we have additional options like exit and acquisition, ventures building, e-commerce roll-up, and bootstrapping. Let's move on and get a better insight of the fundraising landscape. There are several types of funding, including seed funding, Series A, Series B, etc., and also types of investors, including angel investors, venture capitalists, crowdfunding platforms, government grants. The process of reconciling all these involves valuation and equity, which involves understanding pre-money valuation, post-money valuation, and equity dilution. The figure on the right shows the possibility of leveraging online tools to raise funds for a startup. Building compelling pitch decks. A pitch deck is a brief, visually engaging presentation that highlights a business idea, product, or opportunity, aiming to persuade investors or stakeholders to support, fund, or collaborate. A pitch deck addresses 1. Problem and solution. Clearly define the problem you are solving and your unique solution. 2. Market size and growth. Demonstrate the potential of your market and your competitive advantage. 3. Team and expertise. Showcase your team's experience and capabilities to inspire confidence. 4. Financial projections and funding request. Provide a clear roadmap for your financial projections and funding needs. Take time and go through the infographics and master some of the components of pitch deck. Another important factor is the capacity to identify and connect with investors. You need to take the following steps. 1. Research and target. Identify investors aligned with your industry, stage, and funding needs. 2. Networking and relationship building. Attend industry events, leverage online platforms, and engage in targeted outreach. And 3. Warm introductions and referrals. Seek introductions from trusted advisors, mentors, or industry connections. Let's not jump to the art of crafting a winning elevator pitch. You must be clear and concise. Deliver your message in a clear and concise manner, focusing on the most crucial points. Do value proposition. Highlight the unique value proposition of your startup and its potential impact. Then on metrics and traction, share relevant metrics and traction to demonstrate your progress and potential. Finally, wrap it up in a strong call to action. End with a clear call to action, encouraging investors to learn more. On navigating the fundraising process, we got initial outreach and screening, due diligence and term sheet negotiation, closing and funding disbursement, post-funding reporting and investor updates. You also need to learn how to leverage various fundraising tools and resources. Online platforms includes AngelList, Crunchbase, SeedInvest, etc. Investor databases are like PitchBook, CB Insights, etc. 3. Also use financial modeling tools like Excel, Google Sheets, etc. And finally 4, you need legal and accounting professionals. All your moves calls for seeking guidance from experienced professionals. Here is a list of top angel and equity investors: Tim Draper, Ron Conway, Mark Andreessen, Reid Hoffman, and many more. Here are some top grant investors. 1. National Science Foundation, NSF. 2. Small Business Innovation Research, SBIR. 3. Bill and Melinda Gates Foundation. Build a strong team and network. You need diverse expertise. Assemble a team with complementary skills and experience relevant to your industry, and embrace industry connections. Cultivate relationships with investors, mentors, and industry experts to gain valuable insights and support. Now let's explore funding options. Bootstrapping. Self-fund your startup with personal savings, revenue, or pre-seed funding. Angel investors. Seek funding from high-net-worth individuals who invest in early-stage companies. Venture capitalists, VCs. Target institutional investors that provide capital in exchange for equity stakes. Crowdfunding. Leverage online platforms to raise capital from a large number of individuals. Now to craft a compelling pitch deck. In the diagram, you will see the parts you need in your pitch deck. There has to be a problem you want to solve. Clearly define the problem you solve and its significance. Then state a unique, feasible solution to the problem. Articulate your unique solution and how it addresses the identified problem. Research on the market size. Present the market opportunity, its growth potential, and your target market. You need a strong team. Highlight the expertise, experience, and passion of your team. Then highlight the financials. Provide a concise overview of your financial projections and key metrics. Finally, close your quest with a strong call to action. End with a clear and compelling call to action, outlining your request. Master the art of pitching. 1. Practice and rehearse. Rehearse your pitch multiple times to ensure fluency and clarity. 2. Engage with the audience. Maintain eye contact, be enthusiastic, and tell a compelling story. 3. Be prepared for questions. Anticipate questions and have well-prepared answers to address concerns. Look at the pyramid and generate possible questions that might arise from the stated parts and be ready for them. Also formulate the best answers to the questions raised. Learn to negotiate favorable terms with investors. 1. Valuation. Agree on a fair valuation that reflects your company's potential. 2. Equity. Negotiate the amount of equity investors will receive in exchange for funding. 3. Control. Ensure you retain sufficient control over your company and its direction. 4. Exit strategy. Discuss potential exit scenarios and alignment on future objectives. Maintain strong investor relations. 1. Communication. Provide regular updates to investors on your progress and milestones. 2. Transparency. Be open and honest about challenges and setbacks, fostering trust. 3. Engagement. Seek feedback from investors and involve them in key decisions. Investors also check your business strategies. Develop compelling business model. What are your revenue streams? Identify how you will generate revenue from your products or services. And your customer segments. Define your target customer groups and their needs. Then the value propositions. Articulate the unique value you offer to your customers. And finally, the channels. Describe how you will reach and acquire customers. Developing compelling business model canvas. Developing a compelling business model canvas involves clearly defining your value proposition, customer segments, revenue streams, cost structure, and key resources. Focus on aligning business goals with market needs, ensuring scalability and differentiation. Regularly test and refine elements to adapt to changes, fostering innovation and long-term viability in competitive markets. Creating a compelling business model canvas involves defining key partners, core activities, unique value propositions, and essential resources. Build strong customer relationships by identifying target segments and using effective channels to deliver your offer. Clarify costs and revenue streams to ensure a balance between investment and expected returns, driving success. Understanding the funding landscape for startups. Here are some factors to consider when choosing a financing option for your business. The amount of money you need. How much money do you need to finance your business? Some financing options, such as bank loans, have minimum loan amounts. The purpose of the financing. What will you use the money for? Some financing options, such as grants, are only available for certain purposes. The terms of the financing. What are the interest rates, repayment terms, and other terms of the financing? Make sure you understand the terms before you sign any paperwork. Your credit history. Your credit history will affect your ability to get financing. If you have a good credit history, you'll be more likely to get approved for a loan and get better terms. It's time now to cover types of funding sources. 1. Venture capital. Venture capitalists invest in high-growth companies, often in exchange for equity. 2. Angel investors. Angel investors are wealthy individuals who provide capital for early-stage businesses. 3. Debt financing. Debt financing involves borrowing money from lenders, such as banks or private institutions. 4. Crowdfunding. Crowdfunding allows businesses to raise funds from a large number of individuals online. Another crucial step is evaluating funding options. The following are the factors to consider. Stage of business. The stage of your business will influence the most suitable funding source. Funding requirements. Consider how much funding you need and what you'll use it for. Equity versus debt. Determine whether you're willing to give up equity or prefer debt financing. Terms and conditions. Thoroughly review the terms and conditions of each funding source. The diagram showing the different business stages can help you analyze your business better. Businesses evolve through distinct stages. Introduction stage. Launching the product, building awareness, and attracting early adopters. Costs are high and profits may be minimal. Growth stage. Rapid market acceptance, increasing sales, scaling operations, and establishing a competitive edge. Maturity stage. Sales peak, market saturation begins, and focus shifts to efficiency and maintaining market share. Decline stage. Sales and profitability drop due to market changes or competition. Decisions about reinvention or exit arise. Life cycle extension. Innovations, rebranding, or entering new markets rejuvenate demand, extending the business lifespan. It's time to view the steps of the funding evaluation process. You need to take time to define the problem, research the problem, determine the goals, evaluate the feasibility of the project, and make the final decision. The next ultimate step is to prepare your funding pitch. You need to do 4 things. Define your target audience. Understand the specific investors you are targeting. Craft a compelling narrative. Develop a clear and concise story about your business. Showcase your team and traction. Highlight your team's expertise and any progress you've made. Present financial projections. Provide realistic and well-supported financial projections. Navigating the venture capital landscape is also crucial in startup fundraising. You will need to go through the following cycle. Networking. Attend industry events and connect with venture capitalists. Due diligence. Thoroughly research venture capital firms before approaching them. Timing. Timing is critical in seeking venture capital funding. Negotiation. Be prepared to negotiate the terms of the investment. The figure shows the due diligence process. Analyze the purpose of the project. Pre-analysis of the financial business case. Full check of documents. Full analysis of business and case plans. Risk analysis. Final offering creation and ongoing monitoring. This will guide you in accessing angel investor networks. Leverage online platforms. AngelList and Gust are popular platforms for connecting with angel investors. Attend industry events. Attend industry conferences and events to meet potential angel investors. Enjoy referrals. Seek referrals from existing contacts or mentors in your network. Try reaching incubators and accelerators. Incubators and accelerators often have connections with angel investors. This is how to make most of your networking opportunities. Do your research. Dress to impress. Be an active listener. Do follow up. Crowdfunding and alternative funding platforms can also help raise funds for your startup. Employ equity crowdfunding. Platforms like Seed Invest and Republic allow investors to buy equity in startups. Try debt crowdfunding. Platforms like Lending Club and Prosper connect borrowers with lenders. You may also do rewards-based crowdfunding. Platforms like Kickstarter and Indiegogo offer rewards for funding projects. Another fundraising option is securing government grants and incentives. These are the steps. Research opportunities. Identify relevant government grants and incentives. Eligibility requirements. Ensure your business meets the eligibility criteria. Application process. Prepare a strong and comprehensive application. Networking and advocacy. Connect with government officials and advocate for your business. What are the pitches that attract investors? Ensure you do the following. Problem/solution. Clearly articulate a compelling problem and your unique solution. Market opportunity. Demonstrate a large and growing market for your product or service. Team and traction. Highlight your team's expertise and any progress you've made. Financial projections. Provide realistic and well-supported financial projections. Finding the ideal angel investor for your startup. Industry expertise. Seek investors with experience in your industry. Network connections. Look for investors with strong industry connections and relationships. Investment track record. Choose investors with a proven track record of successful investments. You also need to master the funding landscape. Navigating the world of funding can be a daunting task, but understanding the various funding options and knowing how to effectively pitch your ideas is crucial for success. This presentation will guide you through the essential elements of the funding landscape. It's time to view the funding fundamentals. Let's take a close look at the types of financing. Equity financing is where the investors exchange money for ownership in your company. Common forms include venture capital, angel investing, and crowdfunding. Debt financing is when you borrow money from lenders and agree to repay it with interest. Examples include bank loans, credit lines, and bonds. We also have grants and subsidies, where your startup enjoys a non-repayable funding from government agencies or foundations, typically provided for specific purposes. Another option is to consider your own pocket in funding your startup. This is called bootstrapping and self-funding. To succeed in this, do lean operations. Minimize overhead costs and focus on essential resources. Use profit reinvestment. Reinvest profits back into the business for growth. And finally, look into employing your personal savings. Utilize personal funds to cover initial expenses. What do the angel investors look for? High growth potential. They seek startups with a clear path to rapid scalability. Strong management team. They value experienced and passionate founders with complementary skills. Large addressable market. They invest in companies targeting sizable and growing markets. Venture capitalists operate with a specific mindset to maximize returns. First, they focus on an exit strategy, planning how to profit through IPOs or acquisitions. Next, they target market domination, aiming to back businesses that can lead their industries. They're drawn to disruptive innovation, which reshapes markets and creates new opportunities. Lastly, they prioritize a scalable business model, ensuring the company can grow rapidly without proportional cost increases. Understanding these priorities is key to aligning your business with venture capital expectations. Crowdfunding harnesses collective support to fund ideas or ventures. Reward-based crowdfunding offers backers incentives like products or experiences. Equity-based crowdfunding exchanges funds for ownership stakes, appealing to investors. Donation-based crowdfunding relies on altruistic contributions, often for creation or growth needs. It's a dynamic, accessible way to finance projects and businesses. Do you need grants and subsidies? Need some free money? Then identify relevant funding opportunities. Thoroughly review eligibility criteria and application requirements. Prepare a compelling proposal that demonstrates the value of your project. Here are tips for success in pitching and project presentation. Know your audience. Tailor your pitch to the specific interests and needs of your audience. Practice your delivery. Rehearse your pitch until you feel confident and comfortable. Engage your audience. Use visuals, stories, and interactive elements to keep your audience interested. Be prepared to answer questions. Anticipate potential questions and have clear and concise answers. Let's now delve into Unlocking Growth, a guide to seed, Series A, B, and C fundraising. Navigating the fundraising landscape can be a daunting task, especially for startups. This presentation will equip you with the knowledge and insights to confidently secure funding for your business. What is seed fundraising? What is the process of securing early-stage funding? Let's discuss early-stage investment. Seed fundraising is the initial capital injection that fuels the development and launch of your business. It provides the resources for product development, market validation, and team expansion. In attracting angel investors and venture capitalists at this tender stage, you'll likely focus on securing funding from angel investors and venture capitalists who believe in your vision and are willing to take a risk on your early-stage company. Raising Series A, the phase of building momentum. These are the steps to go through. Demonstrating traction. Series A funding builds on your seed round and is crucial for achieving significant milestones and proving your product market fit. Investors look for evidence of customer acquisition, revenue growth, and a clear path to profitability. 2. Expanding team and operations. This round provides the resources to expand your team, enhance your product development, and scale your operations to meet growing demand. 3. Securing institutional funding. In addition to angel investors, Series A rounds often involve institutional venture capital firms, which bring a greater level of expertise and resources to the table. And now we move to navigating the Series B hurdle. First step is scaling operations. Series B funding is aimed at accelerating growth and expanding your business to new markets. It allows you to invest in marketing, sales, and product development to meet increased demand, then demonstrating sustainable growth. Investors at this stage require evidence of consistent and sustainable growth, a well-defined business model, and a clear path to profitability. And finally, building a strong management team. Series B funding often involves building a strong management team with experience and expertise to guide your company through its next phase of growth. Now we come to scaling to new heights with Series C. First is growth and expansion. Series C funding is for companies that are ready to scale significantly, enter new markets, or make strategic acquisitions. It's often used to fuel significant investments in marketing, sales, and research and development. Next is profitability and exit strategy. Investors at this stage are focused on profitability and an exit strategy, such as an initial public offering, IPO, or a merger and acquisition, and then global expansion. Companies seeking Series C funding may be looking to expand their operations internationally, requiring significant capital investment in new infrastructure, marketing, and talent. Each fundraising stage has its own key considerations. Let's look at them now. 1. Seed round. Product validation, market research, initial team building, securing first customers. 2. Series A scaling operations, expanding team, increasing marketing efforts, achieving profitability. 3. Series B. Further scaling, entering new markets, expanding product portfolio, building a strong management team. 4. Series C, significant growth, expansion into new territories, potential acquisitions, preparing for an exit. In the investment journey, businesses move from concept research, idea validation, to business planning, strategy, and team building. Next, product development focuses on refining prototypes, followed by fully commercial, scaling operations. Expansion involves growing markets and products, while preparing for an IPO aims to raise capital and solidify long-term growth. Strategies for successful funding rounds. Develop a compelling pitch. A well-structured and engaging pitch deck that clearly articulates your vision, business model, and value proposition is crucial. Network and build relationships. Attending industry events, connecting with potential investors, and leveraging your existing network can open doors to funding opportunities. Prepare for due diligence. Be prepared to provide detailed information about your company, including financials, market analysis, and team expertise. 4. Negotiate effectively. Understand the terms of the investment agreement, including valuation, equity, and ownership structure. Another key point is how to leverage investor relationships. Follow these steps. Investor network. Investors can introduce you to other investors, mentors, and industry experts. Strategic partnerships. Investors can help you secure strategic partnerships and collaborations that can accelerate your growth. Industry expertise. Investors bring valuable experience and insights that can guide your business decisions. Access to resources. Investors can provide access to resources, such as legal counsel, marketing expertise, and operational support. The road ahead. Turning meaning into success. These 3 steps will show you how to crown your efforts with success. Execution. After securing funding, focus on executing your strategy effectively and achieving your milestones. Growth and innovation. Continuously adapt to market changes, innovate, and stay ahead of the competition. Building a sustainable business. Develop a sustainable business model and a long-term vision that ensures your company's success. Let's close with learning how to make an ask. First, know your target audience. Identify the specific type of investors you want to approach. Second, do a compelling story. Craft a concise and compelling narrative that highlights your vision, value proposition, and potential. Third, clear ask. State your funding requirements and how you plan to use the funds. And fourth, make transparent communication. Be open and honest with investors about your company's challenges and opportunities. Each stage requires the relevant ask depending on the stage of development. The venture capital cycle begins with an idea, advancing through startup and development stages, where seed and angel investors fund concept validation, pilot testing, and early rollout. Growth sees early-stage VC investments driving market penetration and scaling operations. Expansion attracts later-stage VC funding to fuel rapid scaling and market dominance. At maturity, cash flow stabilizes, leading to exit options like IPOs, M&A, or capital returns. Alternatively, missteps may lead to bankruptcy. This cycle bridges innovation and commercial success, balancing risk and reward for investors and entrepreneurs alike.